Assalamualaikum. Welcome to lecture 28 of SBR IFRS 5, which is non-current assets held for sale and discontinued operation. Again, this is a very important standard from the point of SBR exam, which also has a very high chance of coming, and this is one of the easy standard and is a very small standard. Okay, now so here you first need to understand what are the classification, what are the conditions that you need to satisfy to classify an asset as held for sale. Next, measurement. Once it is classified as held for sale, how do you measure it? Third, how do you present it in the statement of financial position and the disclosure? So coming to the classification, okay, these are the conditions that must be met before an asset could be classified as held for sale. They are: number one, item that is available in its present condition for immediate sale. That means immediately you'll be able to sell it in whatever the condition it is. Second condition, sale must be highly probable. Third, management must be committed to a plan to sell the item. Then there should be an active program that looks for the buyer. Then the price, the price should be reasonable in relation to the current fair value. The sale must be expected to be completed within 1 year from the date of classification. That means within 12 months. Then it is unlikely that the plan will change or likely to be withdrawn. So how many conditions are there? 7 conditions. The 7 conditions must be met before you can classify something as held for sale. Remember this. You have to remember this condition. It's a must. Memorize it. Moving on to the next. Once it is classified comes the measurement. Measurement is easy. Why? You have to measure it at cost, at the lower of the carrying amount, or fair value less cost to sell. Lower of these two things, the carrying amount or the fair value less cost to sell, whichever is lower. Okay. When fair value less cost to sell is lower than the carrying amount, the item is written down and the written down is treated as an impairment loss. Okay. If a non-current asset that you are measuring, okay, is measured using a revaluation model, please understand. And if it meets the criteria to be classified as held for sale, then it should be measured to fair value immediately before it's classified as held for sale. Please understand, then if something is measured at fair value, non-current asset, before it is classified as held for sale, you have to revalue it to fair value immediately. Then after it is classified, again you revalue, but this time at the lower of carrying amount and the fair value less cost to sell. Okay, and the difference between these two is the selling price, which should be charged in the profit and loss. Now, when a disposal group is written down to fair value less cost to sell, the impairment loss reduces the carrying amount of the asset in order prescribed by IS 36. IS 36 is impairment of assets. Okay. Now, you can recognize a gain. Okay, a gain can be recognized for any subsequent increase in fair value less cost to sell. But this gain should not be more than the cumulative impairment loss that has already been recognized, either when the assets were written down to fair value less cost to sell or previously under IS 36. In whatever way, gain cannot be more than the impairment loss, cumulative impairment loss. An asset for sale, held for sale, is not depreciated even if it is still being used by the entity. Please understand this. You can only depreciate a non-current assets. Non-current assets means which is held more than 12 months. But once an asset has been classified as held for sale, it falls under current asset. You cannot depreciate it, even if you're using that asset. Now, presentation. Okay, how do you present it? You present non-current assets held for sale separately from other assets in the statement of financial position. Okay. Same for the liabilities. The liabilities of that disposal group shown separately from other liabilities. Then you can disclose it in the statement of financial position or write it as a note. all the major assets and liabilities classified as held for sale, either you write it in the statement of financial position or separately disclose it. Separately write it as a note. Then, where an asset or a disposal group is classified as held for sale after the reporting date, but before the issue of financial statement. After the reporting date, but before the issue of financial statements, details should be disclosed in the notes. Why? This is a non-adjusting even after the reporting period. According to IS 10. IS 10. Okay. Now we are moving on to the presentation. This is how you present. Non-current asset comes your current asset, inventories, receivable, cash, and then this one. Non-current assets classified as held for sale. Changes to a plan of sale. Sometimes there is an exception. What is it? If the sale does not take place within 1 year. Earlier we said the condition was sale has to take place within 1 year. What if it does not take place within 1 year? Can you still classify it as held for sale? Yes, you can. Exception is there. What is that exception? When the delay has been caused due to the factor that is outside the entity's control. Second, there is still a sufficient evidence that sale is likely to take place. If these two criteria are not there, then it is non-current. Then you cannot classify it as non-current assets held for sale. Okay. And please understand, if the criteria for held for sale are no longer met, you have to cease. You cannot keep on classifying the asset for asset held for sale. Then it becomes non-current asset. Okay. Now, the assets or disposal group must be measured the lower of these two things. Its carrying amount. If you are ceasing to classify the assets held for sale in this condition, measure the disposal or asset group at the lower of carrying amount before it was classified as held for sale, adjusted for any depreciation, amortization, or revaluations that would have been recognized if it was not being classified as held for sale. You have to see from the point before it was classified as held for sale, what would be the carrying amount after adjusting for depreciation, amortization, revaluation, and all those things. Then recoverable amount. It's recoverable amount at the date of the subsequent decision not to sell. So it's lower of these two things when you cease to classify assets held for sale. Then comes the disclosure. You have to disclose these things. A description of non-current asset. A description of the facts and circumstances of the expected sale. Any impairment, loss, or reversal recognized. So that's it. Before we summarize IFRS 5, now let us do some questions to understand IFRS 5 better. Test your understanding 14. In test your understanding 14, there have been given two separate scenarios and you have to decide whether the asset is classified as held for sale or not. This type of question means you have to go through the criteria, the conditions that needs to be satisfied. Does it satisfy the condition or not? A. On 1st of December 2007, the entity became committed to plan to sell a surplus office machinery and has already found a potential buyer. Okay, they have committed to plan, already found a buyer. On 15th December, that is after 15 days, a survey was carried out and discovered that building had dry rot and substantial remedial work would be necessary. The buyer is prepared to wait for the work to be carried out, but the property will not be sold until the problem has been rectified. This is not expected to occur until summer 2008. Now, looking at the condition, tell me, can the property be classified as held for sale or not? Don't just say yes or no. First say the reason. See, this is regarding the present condition. Okay, in order to be classified as held for sale, okay, property should be available for immediate sale in the present condition. But they told the property will not be sold until the problem is rectified. So that means they are not available for immediate sale. That means property cannot be classified as held for sale because they are not available in its present condition to be sold. Immediate sale cannot take place. Coming to B, a subsidiary entity B is for sell at a price of 3 million. Okay, some prospective buyer is there, but no sale took place. Okay, one buyer is giving an offer of 2 million and they rejected the offer. The directors have just received advice from the accountants that the fair value of the business is 2.5 million. They have not decided to reduce the sale price of B at the moment. So you see, looks like it's a no, right? This is easy to say. It's not classified as held for sale. Why? Even though there are actions to locate a buyer in place. See, when you're seeing the conditions, don't just see one condition. You have to see all the conditions. If all the conditions are not satisfied, even if one condition is not satisfied, it is not classified as held for sale. Okay, whatever the 2-3 conditions are there in the scenario, all needs to be satisfied. Even if one is not satisfied, not classified as held for sale. Simple. So even if there are actions to locate a buyer, okay, if you see the price, fair value is 2.5, they advertised at 3, so it's not matching with the fair value, so it is not classified as held for sale. You have to reduce the sales price. Until you don't do that, it is not classified as held for sale. Now moving on to test understanding 15 and 16. Test your understanding 15 AB. So here you have been given the fair value of building at 31st December, one at 220 and one at 110. Okay, so the scenario is on 1st of Jan 2001, AB acquires a building for 200,000, expected life is 50 years. On 31st December 2004, after 4 years, they put the building up for immediate sale. Cost of sale is 10,000. Now you have to see. Okay, so the first one, see, before it is classified as held for sale for the first 4 years, from 2001 to 2004, 2001, 2002, 2003 and 2004. For the first 4 year, you have to classify the building as non-current asset. Okay. So the building is classified as non-current asset according to IS 16. Okay, you classify it as non-current asset according to IS 16. That means you have to charge the annual depreciation. Okay, so before the reclassification, the carrying amount. Carrying amount will be C. It is 200,000. Okay, so 200,000 divided by 50. It will be 4,000. Okay, 4,000 into 4 years, because 4 years depreciation you have to deduct 16,000. So from 200,000 you take out 16,000 and it will be 184,000. Okay, this will be the carrying amount. Now coming to A, the fair value. Fair value was what? 220. So you have to measure it after the classification at the lower of fair value less cost to sell and carrying amount. Carrying amount is 184,000. Fair value was what? For A, 220. 220,000 minus cost to sell. Cost to sell was 10,000. So 10,000, which is 210,000. Okay, which one is the lower of carrying amount or the fair value? This one is lower, so it is measured at 184,000. It will be continued to be measured at 184,000 according to A. B, it is 184,000 carrying amount. This time fair value is what? 110. 110,000 minus 10,000, which 10,000, which will be 100,000. Lower is this one, fair value less cost to sell, this time 100,000. But you have to make a note. This time, okay, there'll be an impairment loss. Why an impairment loss? See, before the non-current asset held for sale, it was measured at 184,000. Now it went down to 100,000. So there's an impairment loss of 84,000. The difference, 184,000 minus 100,000. which is 84,000. So this 84,000 is the impairment loss we are talking about in the previous slide. Okay, this impairment loss will be charged to profit and loss as an expense, P&L. Now we are moving on to the next question, which is test your understanding 16, Nash. Discuss the accounting treatment. This is regarding a building. Okay, so now he purchased a building on 1st of Jan 2001 for 1 million, 50 useful life, used revaluation method. Building was revalued 1.2 on 31st December 2002. 31st December 2003, it was classified as held for sale. Fair value was 1.1. Cost to sell 50,000. Did not make any reserve transfer. Discuss the accounting treatment. Okay. So now, before the classification, like test understanding 15, the previous question, do it same way. Find the carrying amount. Okay. Carrying amount from 2001 to 2002. 2001 and 2002, 2 years. 2 years depreciation you have to deduct from 1 million. So it's 1 million divided by 50 into 2 years. Okay. You have to minus this from 1 million. 1 million minus this 2 years depreciation you have to deduct from 1 million, which will give you 960,000. Okay. But it was revalued on 31st December 2002 to 1.2. It went up. So from 960 it went up to 1.2 million. So 1.2 million minus 0.96 million, which will be 240,000 or 0.24 million, you can say 240,000. This is a gain on revaluation. This will go to other comprehensive income, this gain. Now if you see to the December 2003, it went down to 1.1. Okay. So now before that you have to depreciate it. Okay. It was, sorry, this you have to depreciate, this 1.2. From 2002 to 2003 you have to depreciate. 2 years went by. Earlier the useful life was 50 years from 2001, but from 2002 end, useful life 2 years have to deduct. That means useful life will be 48 years. Okay. So 1.2 divided by 48 years, which will be equal to 25,000. So this 25,000 you have to deduct from 1.2. Which will be 1,175,000. Okay. This will be for December 2003 carrying amount. After that, now at that date you also classified as held for sale. See all these things, finding the carrying amount of the building according to IS 16, that means depreciating and all, has to be done before classifying as held for sale. After that, building is classified as held for sale. Now because it is under revaluation method, you have to see it has been revalued downwards now. Carrying amount according to this is this one. You have to compare with this. So 1,175,000 minus devaluation. It went down to 1.1 million. Okay, which is 1. So the loss of 75,000. 75,000 loss. This will be debited to OCI. From OCI it will go. Earlier there was a gain, remember? How much was the gain? 240,000. Now from there 75,000 is a loss. This also will be there in the other comprehensive income. Why? Because previously the gain was there. According to IS 16, revaluation gain, okay, any revaluation gain goes to OCI. And if it is revalued downwards, the loss also will be there up to the amount of that gain. So this loss is less than this 240. So you still can credit, so debit from OCI. That means deduct. Next. Now the building will be revalued to fair value less cost to sell. Okay, so once you revalued fair value less cost to sell, this is the cost to sell 50,000. That means you further have to reduce. See, I told you in the previous slide the difference between carrying amount and the fair value less cost to sell is the cost to sell. It will be further reduced. This is the cost. This goes as an expense in the P&L. So it is 50,000 in this case. Okay, that means the asset will be further reduced by 50,000. Asset goes down by further 50,000. That is the cost to sell. This loss is charged in P&L. In the previous slide also it told, right? The difference is the selling price and it is charged in the P&L. So it's the same thing. So now let us summarize IFRS 5. We started with the classification criteria, starting with items needs to be in its present condition for immediate sell. Sell has to be highly probable. Management has to be committed to plan. The price must be reasonable in relation to the fair value. And sale must be within 1 year from the date of classification. But there are some exceptions. The two exceptions are there for this 1 year period. What is that two exceptions? One, if the event is outside the entity's control, you still can classify it as held for sale even if it's not within 1 year. Second, what is the second condition? Can you recall the exception? You can go back and recall, okay? That's up to you. Now, measurement. Lower of the carrying amount and the fair value less cost to sell. Presentation separately in the statement of financial position under current assets, after current assets. Changes to a plan of sale. Okay, if a sale does not take place within 1 year, still can be classified as held for sale if one of the two conditions are satisfied. Okay, the second condition is up to you to recall. Now that's it for IFRS 5. I'll be seeing you in the next lecture with IFRS 7, again a very short standard, which will link you to IFRS 9, a major big standard and also a very complex and a challenging standard on its own. So thank you for watching and don't forget to subscribe if you haven't subscribed to my channel yet. Take care.